Welcome back, my friends. Significant cracks in the $12 trillion private equity business are emerging with big firms like Blackstone Group, Apollo Global Management, Carlyle Group, and other big players in the private equity field are failing to meet fundraising goals. Actually, they are begging investors for money and suffering losses on some major funds, Fox Business has learned. But, what exactly is private equity, you may ask? Private equity refers to a type of investment in which investors, usually institutional investors and high net worth individuals, pool together their capital to invest in privately held companies or acquire public companies and make them private. Private equity firms typically raise money from investors through limited partnerships or other investment vehicles, and then use that capital to acquire companies or take ownership stakes in them. Private equity firms often seek to make operational improvements and drive growth in the companies they invest in, with the goal of selling them for a profit several years later. Private equity investments can take many different forms, including leveraged buyouts, growth capital investments, and venture capital investments. Leveraged buyouts involve taking a controlling stake in a company by using a significant amount of debt financing, while growth capital investments are used to help a company expand or make acquisitions. Venture capital investments are typically made in early-stage companies with high growth potential. Private equity can be a high-risk, high-reward investment strategy. Investors typically commit their capital for several years, during which time they may not receive any distributions or returns. However, if the private equity firm is successful in improving the companies it invests in and selling them for a profit, investors can earn substantial returns on their investments. Both Blackstone and Starwood have now limited investors' withdrawals from their funds. In fact, investors are pulling their money out of these big real estate funds at a fast pace. What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the doctor knows the patient identity. Private equity has been among the best-performing investment vehicles in recent years. The firms will buy public companies, take them private and sell them at a profit years later. They also invest in real estate and trade various securities to earn returns that often beat the markets. Unlike big banks and securities firms, they receive less scrutiny from regulators, sidestepping the so-called systemically important designation that brings tremendous oversight. Without such oversight, the private equity industry has grown in size, and with that comes a degree of systemic risk to the financial industry that is difficult to quantify and potentially troubling. The sudden rise in interest rates by the Fed Reserve is now wreaking havoc on the PE firms. Large investors in the floundering Blackstone Real Estate Income Trust, which some sophisticated investors say is understating losses. The fund has a net asset value of $65 billion. It's a so-called REIT or real estate investment trust fund with holdings in commercial real estate bought at the top of the market when interest rates were at historic lows. One large investor with knowledge of the fund, known on Wall Street as BREIT, says Blackstone did something unusual and raised billions from individual investors. Amid investor concerns about losses, the fund took the unusual step of halting redemptions. Investors are saying that the fund continues to attract significant amounts of redemption requests and has an uncertain future. These same investors also point to issues at Apollo Global Management, another high-profile private equity company. Apollo Global Management is known for its shrewd deal-making and contrarian investment approach. But executives at Apollo are being accused of begging uninterested investors to put money into its latest fund. While Apollo has listed the performance of the last fund above 20%, many investors are doubting those numbers as well. Like Blackstone, many of these investments were made during the Fed's money printing days. Higher interest rates have now collapsed commercial real estate prices. Actually, the valuations of other portfolio companies have also collapsed. These private equity funds overpaid for stuff and now we're saying, "You're not generating good returns, so go pound sand," said one official at a major public pension fund. They have taken their eyes off the collective ball and they're now collectively panicking that they're badly missing their numbers, the official continued. It's unclear how much the recent decline in business has hurt the private equity business. But, the potential losses could be huge. Many of the private equity companies are now publicly traded and their stock price has begun to reflect the disaster in the making. Shares of all of the major players have sunk significantly. Blackstone shares are down around 20% over the past 12 months. Carlyle Group share are down 14%. Shares of Apollo Global Management are down around 14%. That compares to the S&P 500 being down about 6% during that time. Private equity companies have attracted more than $1 trillion in investor money roughly from 2017 through 2021. But then, the Federal Reserve pumped significant liquidity into the financial system amid the COVID pandemic. Private equity critics say the firms, awash with cash and liquidity, began snapping up investments at unrealistic valuations, and pushed brokers through higher commissions to entice their top clients into new funds. Actually, this sounds a little like a Ponzi scheme. State pension funds and endowments were targets of the fundraising efforts. And these funds are now balking at putting in new money while trying to redeem what's already in these funds. Inflation continues to rise and remain sticky. The Federal Reserve has been steadily raising rates over the past year. Its closely watched Fed fund rate is now in the 4.75%-5% range. Higher interest rates depress real estate prices because it costs more to borrow. It also weakens the valuation of private equity portfolio companies that were inflated when the Fed was printing money. Even the chief executives of private equity companies think that the Federal Reserve is going to have 2 to 3 more rate increases. The prospect of even higher interest rates could further weaken the performance of private equity funds with potentially cataclysmic results. Several mid-sized regional banks, like Silicon Valley Bank and Signature Bank, have already succumbed in this higher interest rate environment. That is because they had to pay more for deposits than they made on loans. First Republic Bank continues to teeter on the brink of extinction and needed a massive cash infusion to stay afloat. It may not survive despite all of that. I bet right now Blackstone CEO Steve Schwarzman is calling everyone he knows in DC to get the Fed to back off, said one large investor. The Fed won't, of course, because no one is going to bail out a bunch of fat cats, he continued. Blackstone and Starwood Capital Group are drawing attention from the Securities and Exchange Commission. The real estate funds have recently seen a surge in withdrawal requests, amid a broad drop in investor sentiment and potential economic downturn. This led both private equity giants to pause redemptions. Blackstone launched the Blackstone Real Estate Income Trust in 2017. Blackstone's fund is called BREIT, which stands for Blackstone Real Estate Investment Trust. The fund is designed to cater to rich individuals. And these rich investors are always looking for better investments. High net worth investors were looking for better returns in what was then a near zero interest rate world. Assets flowed into the fund and it was a success, at least for a few years. The Blackstone REIT amassed $68 billion in assets. But what a difference a year makes. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. Shares in Blackstone shares are down 21% in the past month. That compares to a 3% decline in the benchmark S&P 500 index. But most REITs invest in commercial real estate. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private REIT. President and Chief Operating Officer John Gray defended the positioning and structure. Gray noted that investors knew BREIT had limits on redemptions. BREIT stands for Blackstone Real Estate Income Trust. And, as I am sure you know by now in this video, BREIT is not structured as an exchange-traded fund. So, investors in the fund cannot just sell their shares anytime the stock market is open. Instead, they need to contact Blackstone and request a redemption of all or a portion of their shares. Even if a fund is not tradable on the stock market, it is normally still divided into shares. And real estate is not a highly liquid investment. So, the fund needs to make some sort of judgment as to how much cash it should make available for redemptions. And, in this case, investors in the fund want to take out more money than Blackstone can make. As you might imagine, in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BREIT. Just as a comparison, the $35 billion Vanguard Real Estate ETF has plummeted 26% year-to-date. Well, despite that so-called confidence, investors in the fund sent double the normal amount of redemption requests in November. New subscriptions in the fund experienced a major drop-off. Subscriptions fell to less than $500 million. That compares to $880 million in September. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.